Let's continue the BNN top line discussion. TD and CIBC raising their dividends even as loan loss provisions surge. And with the raise in dividends and exposure to the energy sector, questions do remain about how investors should view the banks right now. We do have one investment manager, Barometer Capital, saying that the firm is not a buyer of the banks. So let's get their take right now. Joining us is Diana Avigdor, Barometer's portfolio manager and head of trading. Diana, good to be with you today. Thanks for joining us. And I know it's busy. You're not a buyer of these banks.
No, everything that you've highlighted above, and if you look at the stock prices, it's not lost on anyone that the expectations for loan loss revisions or setting aside money for these expectations. And so it's not a surprise of what's going on, but we do expect that it continues to increase or to be a risk as long as oil remains at this level. JP Morgan in their analyst day, they did put $500 million aside as well. And Jamie Dimon did say that if oil, for example, was to drop to $20, they were going to reserve $1.5 billion. So the whole industry is aware. It's not so much an issue of where oil is, but the speed with which it came down, and oil companies have not had the opportunity to change their infrastructure and their cost structure through the rapid decline. So this is some of the reasons. We do own a couple of banks, Canadian banks that you mentioned before, and this is the issue. For those portfolios that must stay in Canada, the Canadian banks have some pricing power in terms of what they do with their costs, and they do have a decent dividend, which they are going to protect at all costs. So if you cannot diversify outside of Canada, the Canadian banks are always investable. For us, we manage money for private clients. We do not need to hug the index or get exposed to a relative performance scenario. And so when you have a limited amount of money and 50 other better ideas, then this becomes a secondary decision.
Dana, I just want to get your take a little bit more, though, on the banks, because what is interesting, I think, is the fact that the companies decided to raise their dividends. And some would say that that's a company and a company management that's confident in their outlook, confident in the provisions of loan losses that they've decided to set aside, that they're being prudent, and all is fine. And given the fact that these valuations have come down so much, why wouldn't you look at it as an opportunity? Do you think that there's going to be more negative news to come? We're just not even there yet?
So 100%, it's possible and would be excellent if we could experience a soft landing. It is in the interest of everyone, the banks and the corporates that they're financing, that they come to some kind of solution rather than letting companies go bankrupt and so forth. So it's possible that we come to a soft landing, and in that case, valuations, you're right, are not expensive. Price to book, it's fine. ROEs are a little lower, and it could be an investment. But again, if you have a limited amount of money and 50 other names that have just the same, if not better growth outlook, better price action, perhaps they also have a dividend and don't have so many headwinds, then you put your money there first. And so we're breadth indicators that we're watching in the US, for example, in some technology, some restructuring stories, Microsoft, GE, the defense companies. There is so much more out there. And so for sure, I mean, you don't have to pick bottoms in stocks. You do have to balance your risk reward. And when you're starting to see the price action reflecting that great news that you're expecting, then they become more investable, and maybe they go up in the priority of investing.
In terms of other names that you like, you mentioned a few in a few different areas, but what about within financials?
We don't have any exposure with the exception of those small amounts in Canadian-only managed funds. We do, I mentioned some industrials, not healthcare, technology, consumer discretionary. We are much more highly weighted still in the US. Now, our breadth indicators and our internal tests that we do, and we do a lot, have finally turned Canada into positive readings. However, it is not as robust as, say, some sectors in the US. So we're definitely watching what's happening with oil and with gold and Canadian dollar. And as a trader, as the head of trading, I do see all the different color from the different trading desks. We do see foreign interest has come back to Canada. And I think it started when Rona was purchased. And if you recall, that's when the Canadian dollar really halted its slide, started getting stronger on the conversation that, you know, maybe the world is realizing that Canada has gotten cheap enough. So we're definitely watching.
Diana, when you say you're seeing foreign investors interested in Canada and you're seeing that in the market, whereabouts?
So, you know, you see the Enbridge deal, for example, today. It's raining deals in Canada today and yesterday. It has been a very big surge in demand for this investment today, and it was a pretty big deal. We have reports from different desks and the demand that they're seeing geographically, where their demand has come from, where their orders have come from. You are talking to people that talk to foreign portfolio managers that are feeling, you know, that there is a feeling that perhaps things have gotten bad enough. And to your point, Catherine, if these banks do manage to have, and the energy sector and this whole thing manages to have a soft landing, you know, U.S. economy is not as bad as everybody has thought 4 weeks ago. Really, it was a bit of a, we feel it was a bit of a tantrum and a little bit of money flows, you know. Yes, data has not been so great, but, you know, we're not looking for huge growth. So if we do manufacture a soft landing in this, you know, in hindsight, it's going to be a great opportunity. But again, we are not about picking the bottom and picking the top. We can't do that. We're just wanting to balance risk with reward. And we want the price action in the stocks to actually show that which we believe, if we believe something is getting better. So we want to see that upswing.
All right. Diana, good to be with you today. Thanks so much for joining us.
Thanks for having me.
Thank you.